Hey there, neighbors. Feeling stuck wondering if now's the right time to buy a home or refinance? You're not alone. This week's housing market threw some curveballs. Mortgage rates ticked up, home sales hit a historic low, and inventory's finally giving buyers a bit of breathing room. I'm Michael, your friendly mortgage guy, and today we'll break down what happened last week, what's coming next, and what it means for you. Let's dive in. Last week, May 26th to May 30th, the housing market showed some big shifts. Mortgage rates climbed to around 6.89% to 7.02% for a 30-year fixed loan, up from 6.75% earlier in May, according to Freddie Mac and Bankrate. That's making buyers think twice. Pending home sales dropped 2.2%, hitting the lowest level for this time of year since 2015, and existing home sales are at a 17-year low of 4 million annually. Why? High rates and record low affordability are keeping buyers on the sidelines, creating a 34% surplus of sellers over buyers, the widest gap since 2013. But here's a silver lining: inventory is up. New listings jumped 8.4% year over year, especially in places like the Bay Area, giving buyers more choices. Home prices, though, are still climbing, with the median hitting $414,000, up 1.8% from last year. Economic uncertainty, like talk of new tariffs, is also stirring the pot, potentially pushing borrowing costs higher. Breaking news, what's happening now? In the last 24 hours, posts on X confirm mortgage rates are holding steady near 7%, and economic jitters, like budget deficit concerns, are keeping the pressure on. No major policy shifts today, but the mood is cautious as we head into June. So what should you watch for this week, June 2nd to 6th? First, the Consumer Price Index, or CPI, drops on June 4th. If inflation stays high, expect mortgage rates to stick around 7% or climb. If it cools, we might see some relief. On June 5th, housing starts data will show if builders are ramping up or slowing down, important for inventory. And on June 6th, the NAHB Housing Market Index will tell us how confident builders are. A drop below 34 could signal tougher times ahead. Also, keep an eye on the 10-year Treasury yield sitting at 4.43%. If it spikes, mortgage rates could follow. What does this mean for you? Here's how to act based on your goals. If you're a buyer, shop around for rates. Small differences can save you thousands. Markets like New Orleans or Detroit are less competitive, so you might snag a deal there. Sellers in areas with rising inventory, consider offering closing cost help to stand out. Refinancers, rates near 7% mean it's probably not the time to refinance unless you're at a much higher rate. Wait for CPI data to see if rates might dip. And agents, highlight affordable markets to your clients and stay ready for policy changes like tariffs that could shake things up. The housing market's tricky right now, but knowledge is power. Stay informed and you'll make the best decisions for your family. Want to stay ahead of rate changes? Don't guess. Know exactly when rates drop. Click below to access our free mortgage rate tracker for real-time updates. Hit subscribe, and I'll see you next week with more tips to navigate this market like a pro.